So self-imposed budgets should be reviewed by higher level managers to prevent budgetary slack as well. Now, one of the biggest problem with this self-imposed budget, let me give you a small example, or let's continue our previous example of selling cars. So if the manager asked me how many cards you can sell, I said 15 cards, right? Maybe I exaggerate my performance so that I would be, look good to my job, so that the manager, may not be able to fire me. I'm saving my own job or something, right? I know deep down, I know that I only can sell 5 cards, but I exaggerate my capacity, and I told my manager, look, I'm gonna sell 15 cards, right? So most companies issue broad guidelines in terms of overall profits and sales. So lower level managers are directed to prepare budgets and meet those targets. So let's talk about that. If this happened, I promised to sell 15 cars and managers add 15 cars. I ended up selling 5 cars. So 10 is budgetary slack. It means I am 10 cars behind what I proposed in my budget. So like I said, the budgetary slack can happen, but there are also human factors in budgeting process as well. So what are those? So here we have the success of budgeting process or budgeting program depends on 3 important factors. Number 1, top management must be enthusiastic and committed. This is very important to the budgeting process, otherwise nobody will take this seriously. On this non-serious attitude. Right? Number 2 is top management must not use the budget to pressure employees or blame them when something goes wrong. So this cultivates the atmosphere of hostility and mistrust, rather than cooperation and coordinated efforts in the organization. Right? And the last one is highly achievable budget targets are usually preferred, right, rather than the stretch budget targets. So when managers are rewarded based on meeting budget targets, right? So you should be rewarded what you have actually achieved rather what you have said, right? So a budget committee is usually responsible for overall policy relating to the budgets, and they are also responsible for coordinating the preparation of the budget, and also for resolving disputes related to the budgets, and also approving the final budgets. So all the points, they make sense, right? The question that would be in your mind, that will be how they are used to resolve the dispute. So I'm just going to give you a small example. So there is a constant war or fight between marketing and production department. Production departments, they will say that, look, we book orders, right? But the production departments, they may say that we are already on our full capacity, we cannot produce more than that, right? Or vice versa. The production department say that we are producing and marketing departments are getting less orders, right? So while preparing the budget, so marketing department, number of items to be sold must match with the number of items to be produced. Otherwise you have to pay some warehouse cost and all other storage cost, etc. Right? So there's kind of like natural dispute between these two departments. And now let's talk about the master budget, which is talked about earlier at the start of this chapter, and we are now going to learn this thoroughly. So a master budget consists of a number of separate but interdependent, you can see the arrows here, right? You can see the arrows, right? It means interdependent budget. So we have developed this schematic diagram of budgeting to illustrate the interdependency of various individual budgets, right? And there is a logical sequence in those budgets as well. So the master budget is, it's starting from sales, and from sales we make selling and administrative budget, we make production budget, from production budget we make ending inventory, and from production budget we can budget our direct material, direct labor, manufacturing overhead, and then all those sales, selling and admin, production, ending inventory, blah blah, all goes to, except ending inventory because that is a part of production budget, it goes to cash budget. And from cash budget you can just prepare budgeted income statement and budgeted balance sheet. So we'll look further about the separate but interdependent budgets. So let's start about the operational budgets. In the first learning objective of this operational budget, which is our learning objective 2, is prepare sales budget including a schedule of expected cash collections. Let's talk about that. Okay, so we have the example of Royal Company, so you're going to follow this example throughout your book. Royal Company is preparing budgets for quarter ending June 30. So budgeted sales for the next 5 months are April 20,000, 50,000 units in May, June 30,000, July 25,000, August 15,000. The selling price is 10. So can you make the budget? Simple. How much dollar sales you are going to sell, or you are going to receive the revenue in April, May, June, July, August? You just multiply with the sale price, multiply with the sale price, multiply with the sale price, right? So let's see the solution here. See, so Royal sells one product and that product has selling price of 10, right? So you just multiply the monthly units with the price. So in April the budgeted sale 200,000, May 50,000 multiplied by 10, 500,000. In June 30 multiplied by 10, answer is 30,000. So what about the quarter? So you add all the April, May, June, right, and you get the answer here, 100,000. So total 100,000 units you would be making in one quarter, and sale price is how much? 10. So here is the answer, or you can just add them. Answer is also 1 million, right? So this is sales budget. And now the expected cash collection. So all sales are on account, so it means Royal are selling on credit. So Royal's collection pattern is that 70% collected in the month of sale. So 70% will be received in the month of sale, on the same month where the actual revenue occurs. So 25s are collectible in the next month, and 5% are bad debts or uncollectible. And the March 31 account receivable balance is 30,000. It means we are starting our quarter from March, from April. So March balance that will be coming on the April opening balance would be 30,000. So let's see that. So cash collection, we know that March 31st is 30,000 is the opening inventory. So we know that 70% of the sale gonna be in April. So how much sales in the April, right? So let's talk about that. The sales in the April is 200,000 and 70% will be collected in the month of sale. It means in April. So 70% of 200,000 is how much? 140,000. And what is the 25% will be received in the month following in this month of sale following the month, right? It means 50,000 gonna be received in May. So remember this 140,000 and 50,000, sorry, basically this 50,000 belongs to April sales, right? And 5% are uncollectibles, bad debts, so you don't see a 5% of 200,000, right?